Can the U.S. still tame oil prices if tensions rise in the Strait of Hormuz? Here's what investors need to watch to protect portfolios and avoid surprises. Markets are on edge because a narrow waterway now carries outsized risk. The Strait of Hormuz moves a large share of the world's seaborne crude and natural gas. When threats to shipping increase, prices can jump before any barrels are lost. That's because insurance costs surge, freight rates rise, and cargoes are delayed or rerouted. In this environment, the usual U.S. playbook offers less relief than many expect. The Strategic Petroleum Reserve can add temporary barrels. It can help refiners bridge a shortfall, like in 2022, but it cannot replace a sustained loss of seaborne flows from the Gulf. It cannot fix insurance premia, freight bottlenecks, or the need for specific crude grades. Drawdowns face pipeline and port constraints. The crude in storage may not match what refineries optimally run, and the effect fades quickly if export routes stay constrained. Policymakers still have tools, but none are a silver bullet. Diplomacy can nudge producers and consumers. The U.S. can coordinate with the IEA. Domestic infrastructure can be eased at the margin. Yet OPEC sets key supply decisions and may not align with consumer interests. U.S. shale can respond to price, but capital discipline, service capacity, and geology slow the ramp. Demand-side efficiency helps, but it takes time. That puts maritime security at the center of the price outlook. Keeping sea lanes open relies on deterrence, allied naval coordination, convoying, and fast incident response. Markets price that risk in real time through freight and insurance. Even brief scares can lift benchmarks by adding a risk premium. Longer interruptions can tighten physical markets, especially for grades tied to Gulf export terminals. For investors, oil now links directly to inflation, central bank policy, and cross-asset positioning. Higher shipping costs and risk premia can flow into headline inflation. That can affect rate cut odds and duration risk. Watch OPEC Plus guidance, marine insurance quotes, tanker day rates, and prompt time spreads. Track refining margins, inflation expectations, and policy language from central banks. The practical takeaway is simple. Stress test portfolios for higher for longer energy. Focus on balance sheet quality and cash flow resilience. Know your exposure to fuel costs if you own airlines, chemicals, or logistics. If you use hedges, size them with discipline and review basis risk. And keep dry powder for volatility spikes. Want the full analysis and data? Read the full article at finlitica.com.